Your market news now. Treasury slipped as a Federal Reserve official emphasized that recent U.S. economic data might delay the number of interest rate cuts seen this year. And commodities, oil climbed to head for a solid quarterly gain on expectations that OPEC plus supply cuts would tighten the global market. Gold is steady after a 3-day rally. However, global bond and equity markets are ending the first quarter on a high note, with investors poised for more wild swings ahead after months of the mood swaying between optimism and pessimism about prospective rate cuts from major central banks. To help us look back at the shortened week, we are joined by Ricardo Smith, who is the Chief Investment Officer at ABSA Investments. Ricardo, thank you so much for your time. Let's kick off the discussion by having a look at perhaps one theme that you believe drove markets this week.
Thanks. The biggest theme, would be that of interest rates. We obviously saw the US Fed last week, and this week it was all eyes on the South African Reserve Bank's Monetary Policy Committee. Of course, markets were anticipating a flat policy regime, and the decision unanimous did come through just as that. Other, maybe stock-specific factors that played out, we saw some earnings releases from the likes of MTN and Old Mutual. Strong results from Old Mutual. MTN, the losses really expected off of the Naira depreciation, but beating consensus, and so coming out quite strongly there.
So I mentioned in my intro that, stocks are ending, I suppose, the first quarter on a high note. And we've got two charts for our viewers to have a look at. And the first one actually looks at the equity side of the conversation. And the second chart that the viewers will see will have a look at yield in terms of where bonds were sitting. However, what's your assessment of U.S. stocks when we look at the first quarter?
Yeah, so the first quarter, it didn't start out as positively. We saw a lot of pullbacks off the back of comments around rates staying higher for longer. But as earnings season came through in the US, we saw a lot of positive surprises in earnings. About 80% of the counters actually positively surprising. In particular, the tech sector, there was a strong theme around AI. And so we saw rallies coming out, of that region, and a bit of correlation and pulling through, the markets, and some strong consumer spending from the US and parts of Europe. So globally, it has been a bit positive. It has been a bit concentrated, and some counters, particularly the ones that have rallied in the tech space, are screening a bit expensive at the moment. Unfortunately, locally, we saw a bit of a different picture with a lot of consumer pressure, high inflation, margin pressure, and a lot of sideways movements in commodities, and some job layoffs within the mining sector. So it really does depend on the region, but more importantly, the sector and industry that these counters are in.
Let's look at central banks for a minute and talk about what we heard out of the Reserve Bank. It's quite interesting that they expect inflation to hit the midpoint of their targeted range at the end of 2025. And to me, based on what Lesetja was saying, it just came across as very hawkish. What was the takeaway from you when you read the statement, and I suppose you listened to that Q&A between him and the journalists?
Yeah, it is a bit hawkish. I think that midpoint target, or the idea of the midpoint target, is one that the MPC may have to abandon in the future, because we've hardly hit 4.5%, and it was really during the COVID years that we did. I suppose, to his defense, you'd say that inflation policy shouldn't be led by where inflation is, and it should be the other way around. But when you look at expectations, although analysts do agree that inflation is bound to come lower, if you look at labor and business, they don't see it as low as that. And so there's still quite a bit to go in terms of inflation expectations. But a more realistic target would be perhaps sub 5% than that 4.5%.
If we assume that we still have a long way to go in our battle, for a rather battle against inflation, whether we're looking at the SABC or we're looking at the Fed, what is the impact of this higher for longer environment then?
It just means cost of servicing debt will remain elevated and will increase. From company perspectives who have fixed, their longer dated bonds, there is refinancing risk as they look for more funding. From a valuation perspective, it does put markets under pressure. From a spending perspective, it puts us consumers under pressure from a disposable income perspective. So we'd expect, headwinds should rates stay, as high as they are for extended periods of time. But we do think that, we may still see some rate cuts this side of the year. We're not anticipating them to hold off as far out as 2025. Certainly this year, they're probably going to hold out as far out as the third quarter. But at some point, the environment may actually force a cut. And we've seen the US Fed starting to talk about an inflation range as opposed to a 2% target. And so that may very well mean that once inflation falls below 3%, they may start cutting. And they reiterated that they're looking to cut about 50 and 75 bips in the US, and would expect SA to follow suit.
With that said, I find that we are in quite a weird economic cycle where nothing is quite what it seems, and you've got all these, conflicting signals coming through from different parts. When you look at the U.S. economy, what's your biggest concern?
The biggest concern does remain that likelihood of a recession. A lot of economists have, kind of written it off a bit. But we haven't seen this type of tightening without any economic consequences. And I think some of the factors that they're looking at, like unemployment numbers, which are quite low, tend to be lag indicators and they are lead indicators. And so we still think that there could be a bit of pressure in there. And if the Fed waits too long to start cutting rates, or if they're tracking the uptick of unemployment, then they may cut a bit too late.
Coming into
then from a market perspective, valuations.
Sorry to cut you off there, but I wanted to understand, coming into 2024, has your allocation strategy changed at all when you look back at this quarter?
So we actually positioned a lot of our portfolios quite nicely already mid last year. We did anticipate, some strong rallies in the US given the value that we saw. We did increase our bond exposure, as we viewed that we were roughly at the peak of the rate hiking cycle and seeing some returns from bonds locally and globally. So we haven't necessarily shifted our allocations, but we have been taking a bit of profit from some of the tech counters that have rallied. I wouldn't say we are underweight at this stage, but we are getting a bit concerned about valuations and just taking a bit of profit off the table.
As we wrap up, on screen, the viewers do see the US 10-year, if I'm not mistaken. For you to be positive about the local 10-year, what would you need to see from an economic perspective?
I think containing debt is the largest one. We obviously saw National Treasury tapping into the GFRECA account, which is a gold and foreign currency reserves, to try contain a bit of that debt, but it's not really sustainable on a year-on-year basis. So we'd want to see reduced spending and better allocation towards economic developmental initiatives that would generate more tax revenue in future, which would be self-funding. So that's really the biggest thing. It's the fiscus and no drastic policy shifts. Yeah. We are in an election year. We don't necessarily predict that to have a huge impact unless we see drastic policy changes.
Ricardo, thank you so much for your time. That is Ricardo Smith, who's the Chief Investment Officer at Absa Investments. And just a reminder that because of Good Friday and the Easter Monday, most global stock exchanges, including our own, the JSE, will be closed. However, the exception is going to be for the US markets, which will open on Monday.